This is FRM Part II, Book 1, Market Risk Measurement and Management, and the chapter on correlations. Now, I'm guessing you guys have good memories about the definition of correlation coefficient and what it means. And so some of this chapter is a little bit of a review, but there's enough new material in here to make it interesting. In fact, I think some of it is extremely interesting. So let's get right to the learning outcomes. We're going to define this term financial correlation risk. We'll do that early on. We'll talk about how correlations contributed to the global financial crisis. And then the more interesting topics in this chapter involve the use of derivatives, in particular correlation swap. And then, of course, we need to swing back to what we've been talking about in the last few chapters about value at risk. And then we'll talk about some other risks at the end of the slide deck. This is one of the longer slide decks that we've had recently. So let's go ahead and get to it. Financial correlation risk, the risk of financial loss. All right, so once again, we're worried about that left-hand tail due to adverse movements in correlation between or among financial variables. And here's the deal. Going back to our original investments class when we were undergraduates, we learned that diversification reduces risk. And this is true. Mathematically, it's true, as well as it makes perfect common sense that it ought to be true as well. The idea is that you have assets in the portfolio that are not perfectly correlated, so losses in one asset can be offset by gains in another. And remember how we've talked about things like, a time series of data, and are those parameters stable, or are they constant, or are they fixed? And the answer, of course, is no. So you have changes in correlations over time. And of course, the big deal is that whenever there's a financial crisis, then correlations between and among financial assets, they tend to rise. This is, of course, what happened back in 2007 through 2009 in the financial crisis that we talked about many, many chapters ago. Wrong way risk, we'll talk about this in a future chapter. But essentially, we're worried about things happening that are related to each other that push us to that left-hand tail. Now, one way to manage all kinds of risk, but especially correlation risk, is through derivatives. And credit default swaps are really quite an interesting animal in that they transfer risk from one party to another, and it acts almost exactly like an insurance policy. And here's a nice little illustration. Let's suppose that we're up in that blue box. We're a bond holder, and we bought a bond, and that bond could have been issued by a corporation or a government or somebody else. So we have this reference asset, this bond. And so what are we worried about? Of course, we're worried about receiving those regular coupon payments, but that's not what we're talking about here. What we're primarily worried about in this context is whether or not we're going to receive the par value of the bond. So let's just make a quick example and suppose that's $1,000. So we're getting these coupon payments, maybe they're $100 a year. We're getting them for 5 years or 10 years or 100 years, however long the bond is issued. But we're worried about this big balloon payment at the end. Are we going to receive that $1,000? So we're worried about it. And so what we do is we pick up the phone and call a financial institution and say, hey, if this issuer of the bond fails to pay me my $1,000, will you pay me instead? And of course, financial institutions, this is what they do. They always say yes when you go to them. Now, of course, they're going to price it according to your risk. But they say yes, they're not going to do this for free. They're going to say, you know what, if you pay me fixed amount regularly, then I'll go ahead and insure the value of your bond. So look at the box. I've got this, the credit default swap seller there in, boy, what color is that? I don't know. Can I call it red, orange, or I don't know what color it is. Whatever that color is up there in the box. what they're going to do is they're going to agree to receive these fixed credit default swap payments from us. Now, if it's a AAA rated bond, it might be $10 a year for 5 years. It might be $50 a year for 5 years. But these are kind of like insurance premiums. And then after 5 years, typically credit default swaps are 5 years, although they can be any length of time. We call that the tenor of the swap. After 5 years, if the issuer fails to make that $1,000 payment, then the financial institution will then go ahead and make that payment. You see how that works like an insurance policy. And so, it works just like our home with the fire insurance. We pay, and we hope that we never use it, right? We hope that our house never burns down. In this case, we are just insuring the value of a financial asset rather than a physical asset. Here's an example, just a quick example here. Suppose that we have $100 million invested in bonds issued by the government of Italy. The investor is worried that there might be a default event. Maybe this default event can be because of a trade war, maybe it can be because of terrorism, maybe it could be because of spikes in inflation. I mean, there's all different sorts of reasons why you worry about receiving that $100 million. All right, so to hedge this risk, the investor buys a credit default swap from a Spanish bank. Now, I picked Spanish bank, but it could have been a U.S. bank, it could have been a Japanese bank, it could have been the Bank of the North Pole from Santa Claus, for all that matters. Now, notice in the second circle point there, in case the government Italy defaults, the counterparty, the Spanish bank, will pay the original invested $100 million. Now, that's, of course, if there's a total default. I mean, if the government of Italy pays $40 million, then the credit default swap is only on the hook for the remainder. Now, here's the cool thing about how this relates to the correlation chapter is that the probability the value of that credit default swap, remember that $10 or the $50 every year, and of course you can take the present value of that. So the value of that credit default swap is determined by the default probability of the government of Italy, but also when we bring in this financial institution, there's this counterparty risk that we have to worry about. And so here's the deal, is if Italy defaults on its bonds, is that because of some contagion or some interesting event that's systematic that's going to affect this Spanish bank? And so what happens if the reasons that Italy is defaulting on its bond issue to us as the bondholder are the same reasons why the Spanish bank is going to default on the credit default swap. So we need to worry about both of these risks, right? I mean, what did I say earlier? This could be, the Bank of the North Pole. Of course, I'm being facetious there, but suppose I'm Jim and I have a bank, and I help you write this credit default swap. Well, I may default for lots and lots of reasons, but I may default because of the same reasons that Italy is defaulting. All right, this is an important block point up there. Negative correlation in the context of a credit default swap implies that there's a low probability of joint default. All right, so a high negative correlation implies that either Italy, the government of Italy, or the Spanish bank will default, but not both. So that's important to have this high negative correlation as we search for these insurance contracts to protect the value of our asset. All right, what about this concept of non-monotonous? What does that mean? And so what happens is that the credit default swap spread may show some inconsistency by widening or narrowing when that correlation risk increases. And so this is why we need to make certain that when we enter into this credit default swap, that we pay attention to the daily price movements of that, because correlations can affect these one way or another, and sometimes it's difficult to determine. All right, let's go back to my favorite year, of course, one of my favorite years in finance history, 1964. William Sharpe taught us about the capital asset pricing model, that, of course, diversification reduces risk. Now, this goes back to 1952 and Harry Markowitz when he did the whole efficient frontier and showed us that standard deviation is a really good measure of total risk. William Sharpe, a decade later or so, showed us that, boy, standard deviation is a great measure of risk, but really all we care about is beta. We care about that systematic risk. And then he gave us this concept of this return risk ratio. So the capital asset pricing model suggests that increases in diversification increases the return risk ratio, because as you add stocks to the portfolio, as you add financial securities to the portfolio, what happens to standard deviation? It falls. Now it's going to fall to some level. It's not going to ever fall to zero. That's why we have that systematic risk component. So notice the second block point there. An inverse relationship between correlation and diversification. High diversification is related to low correlation, and of course this makes perfect sense. If you start your portfolio with a company like Coca-Cola and then add Pepsi-Cola to it, and then add Jim's Cola to it, and then add Pacific Cola Company to it, and then add 10 cola companies, what are those correlations between and among all of those different financial securities? Well, if they're not one, they're going to be pretty close to one. So investing in 10 of these is almost like investing in just one. So look at that last block point there. The lower the correlation of the assets in the portfolio, the higher is the return risk ratio. That should make perfect sense. Here's where we get into some review stuff. So let's go ahead, consider that we have a 2-asset portfolio. So we can quickly compute the return on a portfolio. That top block formula, that's really just an F over P minus 1. I've shown you guys that many, many times. So let's suppose we have 2 assets here, and we have a mean of each portfolio noted as mu sub x and mu sub y. Then we have to weight those, right? If the weights are 50%, we would have 1/2 times the first return plus 1/2 times the second return. And of course, down on the bottom left, those weights must sum to 1. And remember, this is one of the cool things that Harry Markowitz showed us back in 1952, is that those weights don't have to be positive. They can be negative, indicating a short position. All right, so what were we doing there? We were calculating the risk of a 2-asset portfolio. Sorry, I got ahead of myself. So the first thing we do is calculate that portfolio return. There's that formula in the bottom box. Next thing we need to do is compute the standard deviation of returns for each of the individual assets. And so notice we have a big square root sign there because we have to take the square root of the variance to get the standard deviation. And notice we're just summing the difference between the actual return and the mean return. We're squaring those differences. And this is the example that I give my students. And just bear with me. And at the risk of offending you guys, I get questions even at the graduate level about why are we squaring these things? So are you ready for this? Where I teach in the finance trading lab, we have 2 rows facing inward, 2 rows here, 2 rows here. So I have like a little hallway. So I walk up and down when I teach. And then of course I got the ticker symbols up ahead of me, and I got the whiteboard behind me, and I have all sorts of fun stuff in the classroom. But anyway, this is the example that I give. I say, let's play a game. Let's play a game called Count the Number of Steps That Jim Takes. So I start right in front of them. Now remember, they're all facing me. So I start right in front of them and I take 1, 2, 3, 4. And I stop and I say, how many steps did Jim take? And they say 4. And they say, Jim, this is not a fun game. This is stuff you do in kindergarten. And I go, no, wait a minute. Let's play along and say, all right, let's play a game called Count the Number of Steps That Jim Takes. However, you have to close your eyes and close your ears. So then I go 1, 2, and I tiptoe, and then I turn around and I come back. And I say 1, 2, and I'm back to the original starting spot. And I say, all right, open your ears and your eyes. How many steps did Jim take? And those who played along said, well, you didn't do anything. And those who didn't play along, which is most of the students anyway, they say, well, we saw you take 4 steps. And I say, that's why we square, to get rid of the negative. because what looks like 0 steps is really 4 steps. Okay, thank you for indulging me on that one there. All right, then we compute the covariance between x and y, and this formula is exactly like the formulas above, but instead of saying x minus the expected value of x squared, we say x minus the expected value of x times y minus the expected value of y. So up top, if you leave out the square root, those are the variances, right? Take the square root to get the standard deviation. Down here, we call it covariance. Covariance measures the strength and the direction of a relationship between two variables. Oh, all right, this is good stuff here. So covariance, we know covariances can be positive, they can be negative, and they can be 0. Positive covariance means that the returns tend to move in the same direction. So if asset X goes up, then asset Y will tend to go up. What does this mean? This is good news if they both go up, but it's bad news if they both go down. So you just see how this relates to the title of this chapter, Correlations. Now, of course, a negative relationship means that if one asset goes up, then the other one goes down. 0 covariance means that when one goes up, you have no idea what the other one is going to do. It has, let's say, a 50% chance of going up or down. All right, so let's summarize this in relation to diversification. If you have positive covariances, then there is less diversification benefits. If you have negative covariance, there's lots of benefits of diversification. If you have 0 covariance, then those returns are unrelated. Let's go ahead and look at the standard deviation of a 2-asset portfolio. And to do this, we need to skip down to the bottom, because in this next slide here, I'm going to give you a little preview. In this next slide here, covariance is not easy to interpret. So I want to go back here to this formula. Look at the formula for covariance. So suppose we're doing the covariance between a share of stock and some bond, all right, and maybe it's a investment graded bond. That covariance term could ultimately turn out to be almost any number. I mean, it could be a positive 8, it could be a minus 64, it could be 0.0005. And so interpreting covariance is very difficult. I mean, it doesn't really make a whole lot of statistical or economic or even common sense to say the covariance between my children's number of made foul shots during a season is 23. That's really hard to interpret, right? But if we put the covariance in the numerator and divide by the product of the standard deviation, econometricians do this all the time. Dividing by a standard deviation, it standardizes a random variable. So when you do that, when you divide the covariance by the product of the standard deviations, you standardize the covariance and you force it. Like, look, covariance could be almost any number. Can you guys see my arms spread? But you put it in a vise when you're doing correlation and you squeeze it. -1 to +1. That's the correlation coefficient. So our standard deviation for a 2-asset portfolio looks like those two formulas there at the top. Notice the top one is the covariance as the far right term, and then the middle formula is the correlation coefficient times the standard deviation times the standard deviation. When I give this to my students, graduate and undergraduate levels, I give the one with the correlation coefficient. But who knows what you guys would face with on your exam. Nevertheless, what we're doing here is this formula here is exactly like, I'm going to go back here. It's exactly like that formula right there. So compute the portfolio return. It's a weighted average. Right here, we're computing the portfolio standard deviation. It's a weighted average. But because Jim was taking 4 steps and then 8 steps and then 2 steps, we have to square it. We have all those squared terms inside of the number of steps that I took, right, so to speak. So we have the weight in x squared times the variance of x, plus the weight in y squared times the variance of y, plus what I call that third term is the co-riskiness, the weighted co-riskiness term. So the standard deviation of a portfolio depends on the weighted risk of x, the weighted risk of y, and the co-riskiness weights of x and y. And you have a 2 there because x co-varies with y and y co-varies with x. When I do this in my classes, I'll say, let's do the formula for a 3-asset portfolio. And my students always want to put a 3 there, but don't do that. It's still a 2. All right, let's get back to what I was saying. Look, the covariance can take on values between a minus infinity and a positive infinity. And infinity is one of those concepts that I really can't wrap my head around, because if you put a big number like 55 trillion, and I can't even wrap my arms around what 55 trillion means, but you can always add 1 to it and make it bigger. So anyway, let me just summarize what I said earlier. It can be almost any number. So what we do is standardize the covariance. All right, so when we have a strong positive linear relationship, correlations that are nearing 1, that's a perfect linear relationship. And then when they're negative 1, that's a perfectly inverse linear relationship. And then 0 correlation means there's no linear relationship. Let's get back to my taking of the steps. A correlation coefficient of +1 is that I'll take 1 step and then I'll come over right next to it and I'll take the exact same step, left foot forward, right? Same thing. If it's a -1, I take the left foot there and then I come over here and take the right foot back. So it's just the exact opposite. And then 0 correlation, there's no telling what kind of dance moves that you make on the floor. All right, let's go ahead and interpret this return to risk ratio. I mean, in the simple Harry Markowitz efficient frontier model, and you can do this in Excel, by the way, using that sum product function, what do we want to do? We want to find portfolios that have lots of numerator and little denominator. Unfortunately, Harry Markowitz called those the unattainable region. You just can't find financial securities that have lots and lots of expected return and little amounts of risk. All right, so this is a really cool graph down there at the bottom. Notice at very high negative correlation. So we're all the way over near the origin. A minus 0.9, let's say, or minus 0.95 results in a return to risk ratio of greater than 250%, as opposed all the way out on the far right. There's that downward slope. We get a return to risk ratio of about 50%. So what does that tell us? As we increase the correlations, like starting with Coca-Cola and adding Pepsi-Cola to the portfolio, what's going to happen? Boy, we're not going to get much diversification. All right, let's summarize this and start working on things that are of more interest to us in this chapter. The previous part of that stuff we've probably talked about, at least in one form or another. Now we're moving into probably not just owning individual stocks or bonds in our portfolio, but we're moving in kind of like into the hedge fund universe, where hedge fund managers are not limited like mutual fund or pension fund managers are. Hedge fund managers can pretty much do whatever they want, as long as they say in their perspectives, I'm going to borrow money from you and I'm going to do anything I want with it. Now let's suppose we have these multi-asset options. So what's an option? Remember, it gives us the right but not the obligation to either buy or sell a security. So how does this relate to our correlation conversations that we've been having so far today? Correlation trading refers to the trading of assets whose prices are informed or determined by the co-movement of one or more assets over time. What's happening here is that if you've got two assets like Pepsi and Coke, and that correlation has been over the last 2 years, say 0.95. But one of those companies, let's say Pepsi, is going to branch off into snack foods and golf putters and kitchen flooring, and they're going to completely diversify. So what has to happen to those correlations? Those correlations, that it's got to go from 0.9 down to 0.8 or 0.7 or some number. So you have this expectation of what the correlation is between and among these assets, and you think it's going to change. All right, so notice what I have in that block point on the right. Traders often forecast changes in correlation in an attempt to make a financial gain. So one of the easiest ways to do this is to pursue what's called a rainbow option. So think about this. Let's suppose that we have three indexes, and we can buy call options on those three indexes, right? We could do those individually. But what we could do is group them into a basket, call it a rainbow option, and we'll pay a premium, and we pick an exercise price, and then the payoff to the option in the future is going to be the difference between whichever of those indexes increases by the most amount. So if two of the indexes fall and one index goes up by 100%, let's say, well, then the option pays off. See, you get the sense it's a multi-asset option. It's a rainbow option because what you're doing is you want to lump those three assets that have lots of correlations, because you want one to go up and then the other one to go up and the other one go up and the other one go up. And so you have this exercise price right here. And if these three indexes are battling it out because they have high correlations, one goes up like this, well, then the option has more value at expiration. Now here's an example of, here's a group of examples down the left-hand column. And the payoffs over on the right-hand column of these multi-asset options. So remember, if we just have two assets, like two indexes, so we've got one, we have the price of asset one, the price of asset two, and then we have an exercise price, call it K. What we can do is we can form a multi-asset option that does all of these things here down the left-hand column. So if we have an option on the better of the two, right, we're going to pick then the higher price. If we have an option on the worst of the two, we're going to pick the lower of those prices. Now, this, of course, is on the expiration date of the option. How about if we have a call on the maximum of the two, then we're going to take the difference, and we have an exchange option, we have spreads, we have options, and then we can throw cash in there. We can have a dual option where we have two exercise prices, and then we can just throw them all into a basket of options and say, you know what, let's let you guys all fight it out. And in the end, if one of you is way up here and the exercise price is down here, then I win. So you get the sense from this table. I mean, this is really a general table. It doesn't give you a lot of specifics. But what it does, it gives you a sense of putting together some derivative securities like an option in a portfolio. And in this case, it's just two, but there's no reason why you can't have 3 or 10 or 100, right? Like, for example, the basket option. And what you're betting on is that some maybe just some of those underlying assets is going to outperform the best. How about a Quanto option? Of course, you know, when you're back here and you're thinking about this, you should be thinking, okay, we can do this with options on stocks. Can we do them on bonds? Well, of course you can, but you know, most bonds don't have enough volatility to warrant these kinds of investments. Some do. But can you do them on other kinds of securities, like an alternative investment? I mean, I suppose there's some financial institution that would be willing to write this out here. By the way, I just saw that some 90-year-old woman or a couple had a painting hanging in their kitchen for 100 years, and it just sold at auction for the largest amount. I can't remember what it was, $26 million or some amount. So anyway, alternative investments, these are really, really cool things. Could you write a multi-asset option on a painting versus another painting? I mean, of course you could. I'm not sure how much the financial institution would charge to write that option. But you should also be thinking, can this work with other derivatives? Can it work with Can it work with swaps? Can it work with futures contracts? And what other kind of underlying assets can it work with? And of course, it can work with exchange rates. And that's what this Quanto option is. And so you have the underlying asset is one currency, but the option is settled in some other currency. And so you get the sense here, what you're doing is that you're trying to make a bet on the relative performance of, in this case, what do I have there? The US dollar and the euro. But since the payoff is in a different currency, then the payoff depends on the correlation between those two currencies. So notice what I have there in that very last sentence. The lower the correlation coefficient, the more expensive is the Quanto option. And that should make perfect sense. Of course we can do this kind of stuff with swaps. I mean, I teach a class called Derivative Securities in the spring semester, and I usually get about 10 or 12 students in there. It's the hardest class I ever teach, but it's the most fun class that I teach, and the students learn all sorts of crazy things about derivatives. And of course, I teach them about correlation swaps. I mean, remember in that one of those first slides today, we did a credit default swap in which we were exchanging fixed payments like $10 a year in return for a promise to pay us $1,000 when the tenor of the swap ends. But we were agreeing to swap an actual payment versus something that we may never get, right? But a lot of swaps, of course, most swaps then were swapping like a fixed payment for a floating rate payment, and that's what a correlation swap is. So look at the bottom illustration. So a correlation fixed rate payer is going to pay a fixed percentage, like let's just say $10, and then we're going to receive. We're going to pay this, and then we're going to receive the actual correlation coefficient between two financial securities, which might be higher than 10%, which might be lower than 10%. So what did I say? We pay $10, and then we might receive $8, and we might receive $12. So you see how this swap works is that two people get together and they say, okay, here's the average. The average is 10% correlation coefficient. One person bets it's going to go up. One person bets that it's going to go down. This is no different than betting on football games or betting on horse races. However, we're betting on a financial security, and whereas a football game takes place over the course of a couple of hours, a horse race a minute or so, right? These correlation swaps can take place over, quarters or semi-annual periods or years or 5 years. I mean, that's probably the top of the line here for a correlation swap. But all we're doing is making a bet. I think correlation is going to be one thing. You think correlation is going to be another thing. And so here's an example of how to determine the payoff, and that should look familiar. So we take the notional, like, what did I say, $1,000 earlier? It could be $100 million. And then all we're going to do is take the difference between the actual realized correlation coefficient minus whatever the predetermined fixed swap rate is going to be. And then, of course, we have to agree on how to compute the realized correlation coefficient. I love to give these sports analogies, and I've done this in one of a previous video. Do you remember years ago when the Steelers were playing in a playoff game and Jerome Bettis, the ref flipped the coin and Jerome said heads, and they looked at it and it was tails, and Jerome says, I called tails. So they had an argument about how to figure out if it's heads or tails. So we need to make sure that we're calculating the correlation coefficient in the proper manner. And so that's pretty much a standard formulation. Let's go ahead and take a look at an example. Of course, we can do this with the swap contract. Here's that fixed correlation of 0.15. And so we agree that this is some kind of an average or an acceptable 0.15 correlation coefficient, notional principal of 10 million. There's 1 year. On a portfolio of 3 assets. So let's go ahead and compute those realized correlations at the end of the year. So the pairwise are 0.6, 0.3, and 0.05. Now, of course, a year ago, we had some idea of what those were going to be, but we want to make sure that we do this on the basket of 3 assets. So there's our formula. And if you do the quick math, you get 0.317, and you can calculate the payoff there. That's the formula. Would I have that right there? Yep. So we take the 10 million and the difference between the 317 and the 15, and so that gives us $1.67 million. Notice I did some rounding there. How about this question? A couple of good answers to this one. How else can investors take a position on correlation coefficients? How about this one? Buy call options on an index. All right, so if you buy the call option on an index, you're betting that the individual index values go up over time or by the expiration date, right? And then if you couple that with selling call options on the individual components, all right, so think about what that means. What would be the best thing that could happen? The best thing that could happen is that the index goes up in value, but every one of those individual stocks falls in value, or at least falls in value below their exercise prices. So that when you sell those call options at expiration, you get to keep all of those premiums, plus you bought those call options on the index, so you win on both sides. Now, of course, it's not mathematically possible for such a thing to happen, but you get the sense of what this means for correlations. What you want is, because there is this positive relationship between correlations and volatility, you want to buy that call option, right? So you want the total index value to increase. But you want enough of those call options that you sold to fall in price. So if you have, let's just suppose there are 100 stocks in this index. If you have, let's say 20 of them who fall in price, well, you want those to have high correlations, and you want those correlations to drag down those other 20, or those other 30, or those other 50. So that you get to keep the option premium on that. So you see how you're betting on the individual correlations. So it might be that the top, let me just pick a number, the top 25 stocks in the index, they all go up by 100%. And that's enough to drag the index to go up by, let's say, 25%. But those 75 stocks that fall in value, maybe they only fall in value by 5 or 10%. So they don't drag the index down enough, but they drag the individual stock prices down enough so that you get to keep those option premiums. And of course, this depends all on the correlation between and among all of those stocks. I told you that there's some cool stuff in here about correlations. Of course, you can do this with swap contracts, right? So we're going to pay a fixed rate in a variance swap and receive the fixed on individual components. And so it's really the same bet. And so an increase in the correlation of all of those securities within an index is going to cause the variance to increase. So you're paying, so think about what's happening. You're paying the fixed variance and you're receiving the floating variance, right? And so what happens when those correlations go up, the variances on all of those individuals then go up, and so you win. Now, of course, you should be asking yourself the question, boy, this stuff that we've been doing in the last few minutes sounds an awful lot like regular old investments class, and then maybe some hedge fund strategies, and then maybe some derivative stuff. Boy, these last chapters are all on value at risk. When are we going to get to value at risk? So here it is. So the impact of different correlations on value at risk. So there's a good old formula for value at risk. And notice in the middle there is the standard deviation of the portfolio, and that can be summarized using some matrix stuff. Look at the second formula. We have the vector of weights, the B's, And remember, we're squaring those just like we did last chapter. And then in the middle is that variance-covariance matrix. Now, do you remember from the last chapter when we were really struggling with coming up with all those risk factors and trying to figure out the value at risk using the most complex method? Well, here, this thing is it's a quick summary of all that. Let me show you what I mean here with this example. Let's suppose that we have two assets, 20 million in asset A, 10 million in asset B, correlation 0.7, and daily standard deviations are 1, 8, and 2.2. All right, so the question then becomes, what is the 10-day value at risk? Now remember, 10 days, that's what we were told last chapter is kind of like the standard in the industry. And then we questioned whether or not that was the appropriate number of days. But let's just suppose it is the appropriate number of days. At a 95% confidence level, this gives us a z-score, or as the chapter calls it, the value of alpha. So that's 1.645. Let's go ahead and compute the 10-day value at risk. So what we're going to do is we're going to use that top formula, and then we're going to use that bottom formula. Let me go ahead and do that for you. Since we have only two assets, we'll have a 2 by 2 matrix. And so note, the top left is the covariance between 1 and 1. The bottom right is the covariance between 2 and 2. So those are really variances. Remember, I told you this in the last chapter, that on the diagonal terms, those are the variances, and then the covariances fill in the off diagonals. All right, so notice the block points down at the bottom. So the covariance between 1 and 1 and the covariance between 2 and 2, that's the variance of 1 and the variance of 2. We just need to square those two terms. So we get a bunch of zeros and then 3, 2, 4, and a bunch of zeros and 4, 8, 4. And then in order to compute the covariance between 1 and 2 and the covariance between 2 and 1, remember they're the same number, we just use that formula that we had several slides ago. So 0.7 is the correlation, and then multiply by the product of the two standard deviations. That gives us a bunch of zeros and then 2772. All right, so there we're filling in our variance-covariance matrix. So there's the vector of amount. So there's 20 and 10, right? That's a 1 by 2 matrix. And then notice all the way out on the right in the second block point, I have 20 and 10. There is a 2 by 1 matrix. And remember, you can't multiply matrices. You can't do 3 at a time. You have to do 2, get the resultant matrix, and then multiply it by the third one. And that's what I do right there. So you get, what do you get? A variance of 2889. Take the square root of that, and you get a standard deviation of the portfolio of about 53%. And then we just plug all that stuff into our value at risk formula. So we're going to take the z, which is 1645, times that standard deviation of the portfolio, 5375. And by the way, don't make this mistake on an exam. My undergraduate students do this all the time. They do all this work and they get the variance of 2889 and they forget to take the square root. Don't do that. And then, of course, we're going to multiply it by the square root of time. Remember last chapter we talked about, is it appropriate to multiply the standard deviation by the square root of time? Does it move through time at the square root? Yeah, pretty much it does. Not all the time, but there we get $2.796 million as our value at risk. Now, what I want you to do is take a deep breath and remind yourselves all the hard work we did in the previous chapter in order to get that value at risk. Here, correlations, they really summarize all those risk factors so that we can arrive at this in a much more speedy manner. All right, let's take a quick look at this picture. So as we've got correlations going on the horizontal axis, going from a -1 to 1, right? So we have a different kind of an origin. It's not 0, 0. And then what happens to value at risk? So value at risk increases as the correlations approach 1. So look at that circle point up there. Negative correlation reduces the overall risk of the portfolio. Of course, we know that. Now, what do we know about that financial crisis that occurred over a decade ago, 2007, all the way to 2009? What do we know? we know that investors had well-diversified portfolios, and they were relying on correlation coefficients of 0.1 and 0.2 and 0.3, maybe a minus 0.1. But when this financial crisis hit, those correlations, which during normal times, during normal times were, what did I say, 0.1 and 0.2 and minus 0.1, but during financial crisis times, those things all go up to 0.5 and 0.6 and 0.7 and 0.9. And so what happens? When we were relying on the value and the benefits and the beauty of diversification, when we were relying on that, when we needed it the most, it failed us because of this wrong way risk that correlations tend to increase in the same direction and towards +1 during times of financial crises. All right, so a good financial risk manager is thinking about this stuff right now to develop correlation models that can track that wrong way risk. Develop correlation models that can track correlations in derivatives and can do it accurately. And then, try to figure out how these correlated defaults are going to affect our multi-asset portfolios. Now, here's a great question. How does correlation contribute to that financial crisis over a decade ago? So look at that first one, a benign economic environment. I'm always fascinated when the economy is going through a normal time, because when you're going through it, you're not quite sure it's normal, but it probably is. So we fueled speculation, loose credit standards. Remember in a previous video, we laid the blame for the financial crisis on a host of financial market participants. Complex credit products. Just look at that simple rainbow option that we just talked about, or these correlation swaps. Once you understand these kind of things, they're relatively simple. But remember, there are individuals and groups of individuals out there who have traded in the past, who thought they understood these products, but didn't. Or in fact, what they didn't do was evaluate the value at risk. What's the worst thing that can happen? And then how do we figure out what to do in that worst case scenario? And then of course, there's model risk, there's moral hazards, and then there's increases in correlations. Now, if you think about this, lots and lots of risks in investing in financial markets. Equity risk, interest rate risk, currency risk, commodity price risk, systematic risks, greatly influenced by how these individual assets behave against each other. Let me quickly go back to that great discussion we had on put-call parity. Remember, I said to you that according to this model, if you don't like what's going on the floor of the New York Stock Exchange, in other words, if you don't like the price of a share of stock, you can replicate that payoff, at least over a short time period, by going to the options market and going to the credit market. So these markets are linked, which means that the correlation between and among all these different types of risk is probably linked. So when we're calculating this value at risk, we've got to consider the covariance matrix. I remember being in graduate school. I had a couple of professors, and these are stats professors, and these are investments professors, and these are corporate finance professors, and they just love this variance-covariance matrix. They talked about it all the time, and I learned early on that this was a pretty important concept, and so it's extremely relevant to all of this risk management principles that we're talking about. All right, how about credit risk? Credit risk, what are we worried about? We're worried about migration risk, and we're worried about default risk, right? And so in order for us to manage this correlation risk as it relates to credit risk, we need to make certain that this loan portfolio, the asset portfolio of the financial institution, is sector diversified so that those correlations are not +1. How about this concept of systemic risk? boy, that simply means that when stock prices decline, then all stock prices decline, right? Remember, I've said this to you before. When you invest in a portfolio of risky bonds and risky stocks, you're essentially betting that the economy is going to expand. And those companies that have issued those stocks and bonds are positioned to capture the positive net present value of that economic expansion. How about concentration risk? What we need to worry about is, are we concentrated in maybe large cap growth stocks or small cap value stocks? And so decreasing that concentration ratio in the equity markets, but also for financial institutions who have all these borrowers on the left-hand side of their balance sheet, increase the diversification to those borrowers. I told you that was a long slide deck, but I also told you that we were going to find some really, really cool stuff to talk about in here. And I hope you found this fascinating as I do.